Hey, listen, everyone. Thanks for joining us. This is the first vlog I'm calling them that we'll be doing. Hopefully, we'll do more. If everyone likes them, we'll do more. If they doesn't like them, we won't do any anymore. But I thought it would be interesting because Jean and I have been talking a lot over many, many years about what we do and the things we see. And we thought it would be interesting to sort of give you some insights from people who have been on the ground in some of these emerging countries, a lot of these emerging countries, and have different insights than the talking heads. So let me just introduce. My name is Tom Samuelson. I'm the CEO of Magellan Yates, which is a financial communications company. My co-host is Jean Van der Wal, who's been a portfolio manager for 30 plus years in emerging markets and is now running a family office called Sycamore Investments. And what we're going to try to do is just give you our sort of insights into things that are happening in what they're calling emerging markets, but I don't even know if that category even works anymore. But places like China, Brazil, Russia, other Africa, regions that are really every day affecting what's happening around the world. I mean, I don't have to. I mean, it's obvious in the crisis we're in today where it originated, but we're not going to even go into those type of topics. But I think from people who like us who have been investing in these countries for many years and have talked to executives and politicians and really got interesting insights that we can give a little bit more of a different type of view than the talking head or the media does. So without further ado, I'm not going to go into a lot of backgrounds because you guys can go on LinkedIn and look at our backgrounds. But the first topic, this first session, we're going to really discuss China and globalism and the role of China in this, in what was globalism and what's happening now, what happened before, what's happening now, and where we might be headed in some type of asset inflation. Which obviously there's two sides to it. There are people that think we'll be in deflation for a long time, and there's others who have an opposite view. So, Jean, thanks again. Let's start by just talking about China, the rise of China, and some people think the relative decline in the U.S. We saw this in the late '80s with Japan. Everyone thought Japan was going to take over the world. Japan, corporate Japan was the way to go. It didn't end up that way. But do you think we're seeing the same type of situation? Talk a little bit about the rise of China and potentially the decline in America.
Yeah, Tom. Thanks for doing this. So, I mean, I don't know about the decline of the U.S. because it has to be seen in relative terms, and given there's nobody else really who can take the position that the U.S. has in the global economy, or the position that the dollar has. But there is a certain amount of dysfunctionality in U.S. politics and in the U.S. financial system. Any financial system that sort of blows up every 10 years is highly fragile. And there's this sense of of great fragility in the system and political dysfunctionality as we're going into an election that could have some big changes. So there's definitely a lot of uncertainty. Now, for China to take more of a leading role in the global economy is a huge challenge. And one of the things that that will impede it from really taking that position is that the U.S. is now firmly providing opposition to China. So China, in essence, it decided some 30 years ago to follow the East Asia Tiger model, and it's done that absolutely brilliantly. It's followed everything that small countries like Singapore and Hong Kong have done, but also Japan and Taiwan and Korea. They all have this formula, based on on very competitive currencies, export-driven growth, intervention in the financial system, and so forth, and very very much top-down policy-driven kind of policies. And it's worked beautifully for those countries, and it's worked fantastically for China. The problem is all those other countries, in essence, were seen as allies of the U.S., and they were small economies. So no matter how successful these countries were, and as you mentioned, Japan was seen sort of as a threat, some 20 years ago, and the U.S. reacted strongly to that. Right, there were all sorts of measures to try to to block Japan, and now China is seen as much more of a threat. So not only economically but also politically, because its system is seen as something nefarious that is unacceptable, to a world that should be moving regimes. So after all this success, China is facing major challenges here from this new Cold War environment that's largely been dictated by the U.S. And if anything, during this campaign will be, I think, one of the pillars of this campaign. You'll be hearing about China constantly. And so the question is, what happens after the election? And I think that, it's quite unclear, but certainly the trends are towards more antagonistic policies towards China. So China has a challenge then of, what does it do now? It's unlikely to change its model, which is, at first has worked extremely well. So convincing anybody in China to change something that's worked very well is difficult. But also, the country is very much driven by domestic politics, right? That's what they're concerned about. So anything outside of internal issues is really secondary to
Exactly.
China. So to be successful in this sort of rise of an alternative hegemon of somebody who can actually challenge the U.S., they have to be very successful in diplomatic initiatives around Asia. If they're successful, in arriving some kind of a partnership with their neighbors, with Japan and Korea, Taiwan, and so forth, and Southeast Asia in particular, which is sort of their emerging markets, then I think China can continue progressing. If domestic politics doesn't even allow them to do that, then I think they will face increasing challenges. And then what happens is, we move much more into this bipolar world and more Cold War environment, which would not really be constructive for anyone or for investments.
Yeah, Jean. So one key point you made there, and I think that's very important for people to understand. And people, I don't know people really get this part, but you mentioned something that I've been saying for a long time, that the number one thing for China is internal, right? Is jobs. It's keeping people happy, right? The happy society, because that's their biggest threat. The biggest threat is internal, not external. So when we talk about what has the era of Trump and obviously coronavirus, one of the things, outcomes of this, and we discussed this a number of times, is the beginning of the end, or maybe the end of globalization as we knew it in the past. And that China obviously has thrived on globalization, but in the end, as you mentioned, it's internal that they're more concerned about than external. So when you look at the end of globalization at the beginning of regionalization, and what is the inevitability of U.S. and Europe and other countries bringing back supply chains internally? How does that affect China? And then I guess that'll go into some other topics. But give me your views on that.
Yeah, so depending on how quickly it happens, it could be very, very different stories. So, but you're seeing it already. Apple announcing they're going to open up a factory in Vietnam last week, and then TSMC announcing they're going to build a foundry in Arizona. So this kind of stuff, it's definitely happening, and I think you can see it. You can see it in one very negative way, sort of as an end of globalization, or you could see it in a more positive way in companies just taking conservative measures to protect their supply chains over the long term. And so depending on on how quickly it happens, and now how aggressive governments are in promoting this, it could just really sort of accelerate a regionalization process, which may not necessarily be so negative, right? So Asia is now the biggest market in the world. It's the fastest growing market in the world. If China, as I mentioned before, through good diplomacy, can secure its place sort of at the center of the Asian economy, and then China is such a big market in itself, right? It's now the second largest market in the world. So what you're going to have is multinationals are still going to have to be in China if they want to be successful. And so it's not as if Apple is going to abandon China. Just supplying the Chinese market is huge enough that Apple has to do it, and so do all the other major multinationals. So I don't think anybody's going to reduce their interest in the Chinese market.
No.
Depending on how successful China is in remaining at the center of supply chains in Southeast Asia, then the world continues on a more sort of regional kind of framework. For the U.S., I think it's potentially less attractive because the U.S. is low growth. The If we move into a world of regionalization, the U.S. region is not the most dynamic in the world, right? It's You can see that the U.S. being more focused on North America and South America. Well, these are just not dynamic regions. They provide some good supply chain opportunities, particularly in Mexico, but they would sort of put the U.S. At sort of at the margin of the highest growth region of the world. So I don't think it interests the U.S. at all to have some kind of a radical scenario here. And U.S. multinationals will fight very strongly to remain key partners of any kind of a Asian region, right? It's For a company like Apple, not to be a key player in Asia would be a huge negative.
And what obviously you talk, there's going to be implications here for currencies, right? So what do you think is the implication for the dollar? I think there's a lot of talk about the renminbi. I'm not so sure that's ready to be floated, but what's your outlook on how this is going to affect the dollar and possibly the floating of the renminbi as a global currency?
Yeah, so China definitely has as a long-term objective to increase the stature of renminbi. But I think over the short term, I don't think it's easy, and I don't think they want to move very aggressively. First, they don't want to open the capital account. Second, I mean, currently, with the fiscal deficit in China and the potential capital flight, with the lack of confidence of Chinese investors in China. I mean, the last time they tried to open a bit, there was so much capital flight that they had to move back quickly. So around the 215, 217 period. So the Chinese see this as a long-term thing. They've been opening up investments, to foreign stock and bond investors, and I think they'll continue doing that. The key to that, once again, goes to the whole ability to really, through diplomacy, increase its stature in the Asian region. Because if you see, I mean, for the U.S. to have really had the dominant currency, since the 1970s, U.S. has had to currently run current account deficits. It's very difficult to be a dominant currency if you don't run current account deficits because you need to supply your currency to the world. So the Chinese have never done that. So if you see the Chinese over the next 5 years, 5, 10 years, start running current account deficits with the Asian region, what they would be doing in essence is increasing the stature of the renminbi. And I think that may happen. So that's, once again, it goes back to this question of how China wants to see itself from a diplomatic point of view, in the Asian region, and how successful they are at building the partnerships and the alliances and the economic ties in Asia. If they are successful doing that, the likely consequence is current account deficits for China and the growth of the renminbi in the Asian region. And then also they will be doing this, with certain partners, particularly commodity producers and so forth. So maybe countries like Brazil will own more renminbi reserves and so forth over time. I think it's a gradual process. I don't think there's no threat to the dollar over the short term. Quite the opposite, I think. In this environment of global uncertainty, we're likely to see the dollar strengthen, and then that raises a question, of emerging markets and how they can, thrive during this environment of dollar strengthening, which is likely, over the next year or 2 years. And that's a big problem because there's emerging markets have raised so much dollar debts since the great financial crisis, and they're actually quite in a quite fragile and vulnerable situation right now.
Yeah, and that that brings us to the next topic. We have a couple more to go. You talk about debt, right? So when we look at debt to GDP, the global debt situation, everyone is borrowing more, printing money. This is just a continuous situation, especially now in the U.S. and obviously Europe. So when we look at this fiscal expansion, when we look at like we talked about QE to infinity, this is not going to end well. And so what's your view of how long can these governments continue to do this before the typical debt investor, which is now the government itself, because they're bailing out fixed income ETFs, but at what point does the fixed income investor just say enough is enough? And where do you think we're going to see some of these debt crises start? Is it Europe? Is it going to be Asia? How do you see that, or Latin America?
Yeah. So if the dollar continues appreciating, so if we look at the DXY, which is currently a little bit over 100, if it moves back to the 105 level that we saw in March, that would be a sign of big stress in the dollar market. And the Fed has intervened very aggressively, over $1 trillion in swap lines to allies, not to China. So, but to the countries that the U.S. considers to be allies from a political and economic point of view, they provided these swap lines. But if we go back in that environment, I think the probability of an emerging market debt crisis increases a lot. That's a big concern. That's a big concern for China. China has been the largest borrower of dollar debt, particularly Chinese real estate companies. And so, which makes no sense for a real estate company, that has its entire client base and domestically to be raising dollar bonds, but they have. So there's a huge amounts of Chinese real estate dollar debt in the market, and so the Chinese authorities then would have a big question of what to do in sort of bailing out these bonds. But it's not just China; it's all over emerging markets. There's been enormous amounts of dollar borrowing. And I don't know how that gets involved. That could be the epicenter of any sort of crisis that we see over the next year. So I do believe in this dollar strengthening scenario. So I don't think I think over the short term it's more uncertainty that's causing this. But you have to think about it in terms sort of relative currencies. And if everybody else is trying to debase their currencies, then the dollar, it may be trying less hard than other countries in debasing their currencies. So you have to start looking at sort of alternative currencies like Bitcoin and gold, and those are definitely appreciating relative to the dollar. So I think we're seeing the markets are telling us, that there is a process of dollar debasing happening, and it's probably accelerating. You see how gold has been rising quite quickly. So that's the first sign that we want to see, and then over time, if the policies continue in terms of a Fed monetizing of the debt, and fiscal deficits, then I think the U.S., over the next 2, 3 years, will get in a situation where the dollar is likely to weaken,
Right.
uh, because the U.S. is going to have to enter into a phase of, a financial repression, basically. So
Exactly.
something similar to what we saw in the 50s in the U.S.
So that brings us to just to sort of round things out. Um, we've both talked about this, the gold since last year, being very bullish on gold, and obviously gold's in a breakout situation. But when we talk about reflation and we talk about dollar strength and eventually dollar weakness, what that all amounts to is a commodity cycle that we haven't seen since potentially since the 70s. So talk a little bit about I think we both agree that we're in a deflation, dollar strength in the short term, but eventually that's going to reverse, and that is going to be very positive for both commodities and emerging markets, which are obviously getting hit very hard. So this could potentially be an amazing buying opportunity. We're talking about longer term cycles here, not over the next month, but talk a little bit about your view, which we both agree on commodities and eventually another potential bull market in emerging markets.
Yeah, I agree completely with that thesis. The problem is the timing. Emerging markets have underperformed for about 10 years now. So to tell investors that, we could underperform another two as the US goes through its deflationary phase, it's not a nice thing to say. But that is my view. I continue to be quite bearish on emerging markets. I'm, in my global allocation strategies, I'm about half weighted emerging markets. I do think we get this deflation for a significant amount of time, and then eventually, when the dollar starts losing strength, and once again, you'll see this in dollar and Bitcoin, you'll see this in gold and Bitcoin, and so forth, and eventually, the dollar will really start losing strength relative to other currencies. And then that's a sign there really that a reflation process has started, and contributing to that process will be what we see in the regionalization and reducing supply chains and financing the fiscal deficits and so forth. So that's I think that's the next big trade for emerging markets. When it starts, I'm not sure, but probably not until 2021 sometime, or and then these trades tend to last for multiple year periods, so that could be another good run for emerging markets, and you'll see it happening as the dollar weakens, and typically that's what happens when the dollar weakens. So emerging market currencies strengthen and the stock markets go up at the same time, and so these can be very powerful rallies. That's very likely to happen sometime over the next 2 to 3 years, in my view.
Yeah, I mean it's definitely setting up that way. And just give me your idea of some of the countries you think that could, after obviously going through a tough period of time, which almost everyone's doing, some of the countries that could really benefit from a reflation down. Let's say if it's 2021, which is not that far away, but what countries do you think would benefit from this?
Well, that's obviously the commodity producers. So that's the Brazils and South Africa, Indonesia, Russia, all the commodity producers. They'll be extremely cheap by that time. They're already cheap, so they start in very very cheap levels with very weak currencies, and that's when you get these moves where you can make 4 or 5 times your money. And then also countries like Mexico that are extremely well positioned from a supply chain point of view. So once Mexico gets over its current political problems, then that market should be very good. Now, over the short term, there's still ways to make money in emerging markets, and that's in essence with the long duration kind of technology plays in emerging markets that are becoming extremely important, right? So really, the only thing that's been working in emerging markets has been technology. So Chinese technology companies and other companies in Korea, in Taiwan, and even here and there in other emerging markets like Brazil, Argentina, and so forth. You do get some interesting technology plays, and that's, I think, where investors need to focus over, over the short term.
Yeah. Um, and obviously, investors globally have it's been for almost 9, 10 years a momentum market, growth orientated market, technology or U.S. centric technology orientated. Now, obviously, as you mentioned, emerging market, but eventually there's going to be a rotation out of growth because either that growth is going to stall or there's going to be so much competition that you're not going to be able to keep those kind of multiples. So I guess the final thing is, how do you see this working out, this rotation eventually out of growth? Because if your scenario is correct, and we both think it is, if commodities and we have a reflation, these growth plays are going to die on the vine to a certain
Yeah, it's,
extent.
it's not a coincidence that both value and growth and both value and emerging markets have underperformed over the past 10 years. In many ways, they're linked. So they're both short duration assets, right? They're not long duration assets like technology companies that benefit from very low interest rates. So that's what needs to change, right? And that's what reflation will do. It'll increase interest rates, increase inflation, increase interest rates, and that should create the rotation from growth stocks into value stocks, and in essence, emerging markets, they'll be part of that trade, right? They'll be a big part of that trade, because in addition to the rotation into short duration, you get the currency appreciation. So you get sort of a turboed rotation by being in emerging markets at that time.
Yeah, no, it makes sense. And I think we both agree this is probably 6 months to a year away, but in investment term time time frame, that's not that far away. Anyway, so I think that's it. I'm going to wrap it up here. Jean, thanks very much, and hopefully we get some good views out of this, and we'll do a few more of these and see. We'll pick different parts of the world or different countries and talk about them in sort of a more micro context. But anyway, thanks again, Jean, and have a good week.
All right, thanks a lot, Tom.